Hello and welcome to today's RIMS webinar, sponsored by Descartes Underwriting, Parametric Insurance, and Climate Risk, an innovative tool for cat risk management. I am Justin Smolison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. A few notes before we get started. If you have a question for the presenters during today's session, please submit them by writing in the question box. Feel free to ask at any point during the presentation. We will answer as many as we can during the Q&A portion at the end. And for those we cannot address, the Descartes team will reply to you directly. And yes, following this session, Descartes will make the slides available through their communications. Following this session, the recording will be available also on the on-demand events page of rims.org. And all downloads and contact information will be accessible to the sponsor. And folks, before we get started, I've got a really special plug for Risk World here. As you might know, Risk World will be held in Chicago May 4th through May 7th. rims.org/riskworld is where you go to register. And our friends at Descartes Underwriting have two sessions at Risk World. The first is on Monday, May 5th on the global stage, booth 825. Brian Thompson will deliver parametric insurance from buzzword to coverage solution. And on May 6th on the Thought Leader Theater stage, Tiffany Kinney of Descartes Underwriting will deliver the evolving wildfire landscape. Lots to discuss there. Remember, check it out at rims.org/riskworld. And on with today's presentation. By offering quick access to liquidity post-event, Parametric Insurance ensures that funds are available to address both direct and indirect losses, such as business interruption, without the delays of the traditional claims process. Today, Will McMillan of Descartes and Austin Castle of Lockton Companies will discuss how parametric insurance complements conventional coverage by filling gaps such as deductibles, excess layers, or exclusions under traditional policies. RIMS is thrilled to welcome a large global audience, and now I will hand it off to Will McMillan of Descartes.
All right, thank you, Justin. Appreciate the intro. Good morning, good afternoon to everyone, depending on where you may be in the world. Thank you for registering, and looking forward to discussing our company and how we're able to help corporates build more resilience in the face of catastrophe events using parametric insurance as an innovative risk tool. So a little bit about the agenda today. We'll start off kind of talking more broadly about parametric insurance, what it is, some key concepts, types of parametric covers. We'll look at a comparison to traditional indemnity insurance. What do these products do differently? What do they do similarly? And ultimately, how can they best be used together to create the most robust insurance programs? Then we'll look at some examples of actual structures that are common in the marketplace today, primarily looking at hurricane, wildfire, earthquake, tornado, and hail structures. We'll look into the trigger mechanisms that are used, the data sources that are required to make these solutions impactful. And then from there, we'll go over to Lockton to hear a market update, get an understanding of where the traditional property market is from a capacity terms and conditions standpoint. And then we can learn a little bit about how these parametric covers are actually being placed today in the market. And then we will follow that up with some Q&A. So feel free to submit some questions as we go. We'll try to get to everyone, as Justin mentioned. But without further ado, we'll kind of kick things off here with intro to parametric. What is that word that seems to be popping up more and more in today's marketplace? And really, parametric insurance, it's nothing new. It's been around for quite some time. I believe the first index-based or parametric policies were traded in the 90s, primarily for weather-related covers, excess rainfall, too little rain. A lot of these contracts were used in the agricultural sector, particularly around crops and hedging yields. But since then, there's been quite a bit of a shift to use these policies to cover more catastrophic related events. And the reason for that is really, on one hand, you've got a traditional marketplace that I think in certain geographies, these risks can be very difficult to cover for a lot of the established players out there. And so it creates kind of a squeeze in the market that can lead to to higher prices, higher retentions, increased rates. And it could be, difficult to ultimately transfer the risk that's needed from the client to the carrier. And so on the other arm, you also have new improvements and developments in technology that has allowed parametric insurance to be much more effective, particularly in the way we monitor and track events in real time using whether that's satellite-based technologies, radar data, sensors, general kind of IoTs have enabled us to more accurately monitor these events. And that really makes parametric insurance a much better value add than, when the technology just may have not been quite there. So that's kind of the main reasons we've seen these sorts of covers take off in recent market cycles. But that being said, really on its face, parametric insurance is an alternative type of insurance contract that essentially pays a pre-agreed or predefined level of indemnity for pre-agreed event thresholds. And so essentially that's saying the cover responds not based on actual losses sustained or actual adjusted losses, but based on the intensity of the event in question. So when we think of hurricane coverage, that could be, say, a certain payout that's associated with a Category 3 hurricane coming within a very specific predefined distance from a specific GPS coordinate or location of a client site. And that allows us to kind of really dial in the coverage to only respond to specific events that may cause a specific pain point for a client. And so, what's key about parametric insurance is the underwriting focus is entirely on the peril. We're essentially asking ourselves, what is the probability of a specific event to occur at a specific place on the globe? And that is really what informs the pricing, the claims payout, and that is what allows us to ultimately offer these sort of contracts on a peril-specific basis, as opposed to kind of an all-encompassing, all-risk property program that you might be more familiar with. Doing this has a few implications. Arranging an insurance contract in this way, it allows us to, one, tailor make a policy or a coverage depending on very specific quantifiable parameters. And so if we can model a client's risk exposure, we can have a really good understanding of where they're vulnerable to different event thresholds. And that allows us to create a very quick and streamlined claims process. So as soon as there is an event that triggers that policy, we're able to very quickly, all parties know exactly how much of the payment has been triggered, and we're able to actually remit funds in a matter of weeks as opposed to months or sometimes over a year. You'll see on the traditional side with some of these heavy catastrophic event scenarios. And this also allows us to not only cover structural physical damage that may result from a catastrophic event scenario, but also any sort of indirect financial or economic impact. So really think non-damaged business interruption, extra expenses involved with a devastating event. It's really kind of an instantaneous cash infusion that the client can use to cover any sort of loss or increased cost resulting from the event. So the capacity has a much broader use, I would say, than what you'd be used to on the traditional side. Is what's considered a loss is really quite broad as far as how a client has been impacted by a specific event. And then the other, I would say, very important and different aspect of a parametric cover is that it allows us to backtest the coverage against prior event scenarios. So for example, going back to hurricane, if we know a client lost a certain amount from Hurricane Ian, for example, then we can go and look and model out, well, where were their assets relative to Ian's track? What were the wind speeds that impacted them closest to the track? and that can kind of give us an idea of where they're vulnerable. And had they had a parametric policy in place, we can show how it would have responded for those prior event scenarios. So this allows us to really kind of dial in the coverage to meet a client's unique specific needs and tailor the cover in a way that responds exactly when they need it within a budget that makes sense. And there's a lot of different kind of levers we can pull to find the right kind of sweet spot between what they need from a coverage standpoint, what they're trying to ultimately transfer, and what events they'd ultimately be happy or be comfortable with insuring themselves. So it's a very nice way to kind of calibrate the cover, looking historically at some of those prior events. Also on this slide, I think it's key to point out that the data that is used to settle the policy must be third-party data. Otherwise, there could be conflict of interest, and it must be objective, measurable, and it's fundamental that whatever index or trigger point you're using accurately reflects expected losses. And so choosing that trigger and that data set that you use to settle the policy is fundamental to a effective parametric cover. And so the focus today is natural catastrophes for a variety of perils. I've listed some of the common ones here, but really parametric insurance has other applications as well. I mentioned yield production. That could be crop yield, that could be carbon credits yields, renewable energy yields. There's also parametric products out there for the market and broader economic yields. A lot of times these are traded as derivatives. And then you also have different cyber parametric triggers that maybe pay out based on cloud downtime or a specific duration of business interruption. And then you've got pandemic triggers out there that are based on number of confirmed cases in a specified geographic region or government imposed lockdown. So this is just kind of showing that there's a lot of different approaches to a parametric cover. The focus today is natural catastrophes. This is what I think the market is seeing the most demand for currently. And, taken with different, I would say, shortcomings on the traditional side, it's a really kind of elegant way to make some of these PDBI property programs whole, so to speak, and cover some of the excluded items or sublimited or maybe a hedge on a high deductible or loss limits. And so really why parametric, I think, is gaining traction in the market is really due to insufficiencies on the traditional side. And so what that means is, and for certain types of risks that have, particularly had adverse loss histories or in a geography that is frequently hit by severe weather events, traditional capacity may be too expensive to come by. It may not be adequate for the needs of a specific client, or it just might be unavailable, just depending on the nature of the risk. You also have exclusions under traditional policy forms, such as non-damage business interruption. Typically for traditional all-risk policies, there requires to be physical damage in order to trigger the business interruption. That's not necessarily the case for parametric. As I mentioned earlier, it's a great way to cover that broader indirect economic impact that is oftentimes not picked up in a non-damaged scenario. So it's a great hedge on non-damage business interruption exposure. And then, as I mentioned, you're seeing increased rates, increased retentions, loss limits introduced to policy languages. And so parametric is a great way to fill those gaps in a traditional program and address some of those items that are excluded or not covered adequately under a traditional policy. And so this chart kind of further drives that point home. You see the darker blue bar on the left is global economic nat cat losses, and then the smaller lighter blue bar is insured nat cat losses. So that the difference is the protection gap that parametric policies do such a good job of addressing. And so in aggregate, there's clearly an issue of not adequately covering the total impact from different nat cat events. And so parametric policies are a great way kind of fill those gaps and provide insurance for items that are typically either uninsurable or not insured adequately. And so I don't ever like to compare parametric and traditional on a true apples to apples basis, but it does um really help drive home the main differences, I would say, in the approach. But I think it's important to understand that um these sorts of insurance options are best work complementary to each other. But I think this slide really does a good job of summarizing the main points here. The loss trigger for parametric, it's event based. It's based on shake intensity from an earthquake, or area burned for a wildfire, or wind speed when we're talking about hurricane. For traditional, the trigger is based on actual inspected loss or damage. And so that's a key differentiator here. The policy periods in traditional coverages are typically annual. Long-term agreements are possible, but for parametric, typically that's much more flexible. There's short-term agreements just covering a specific critical risk period. During the summer, for example, if your business is prone to flash flooding, for example, during a specific few months out of the summer, we can arrange a policy that just is on risk for that short time. Or multi-year agreements are also common in this space as well, covering 2, 3, sometimes up to 5 years on a single deal. And like I mentioned, the policy structure in parametric is very straightforward. It's very transparent. It's clear what events are covered, what events are not covered, and there's not a whole lot of room for ambiguity, I would say, in the policy wordings. It's very clear what the coverage is meant to respond to and what events it's not. On the traditional side, that's generally more standardized policy wordings. It's can be seen as a take it or leave it approach, which on parametric we really try to kind of dial in and present something that's bespoke and tailor made towards a specific pain point or need of the client. Another nice, I would say, benefit of parametric insurance is the premium stability. So I mentioned that the rates are pretty much exclusively determined based on that probability of an event happening or not in a specific area, which really is not going to fluctuate much year over year. And so that's reflected in premiums. I think across the board, we've seen a lot of accounts that have been renewed flat this year, and that's by design. That's how the cover is meant to operate, and that's can also provide a very nice hedge against the volatility that one might see in the traditional markets from year after year. Uh, we Parametric does not penalize for having prior losses. It's really we do not loss rate, and so even there's been scenarios where we've had claims, and within the same policy year, we've been able to reinstate that limit at the same rate that was selected at binding. So much more stability when it comes to pricing and premiums. Claims process, this is probably the biggest difference, and it's all streamlined, data driven on the parametric side, whereas traditional, you have an on-site manual claims adjustment process that determines the ultimate loss, and that has kind of a timeline that can can be a little unknown as far as when a claim will be fully adjudicated. And then I think one important point when discussing both parametric and traditional insurance coverage is the idea of basis risk. And this is basically the difference between an actual loss and what you're receiving from your insurance company. And so if designed properly, parametric covers reduce or minimize the basis risk by choosing those trigger thresholds that are at a point that's you're expected to incur a loss. And so really the design of the policy is where we try to mitigate basis risk as much as possible. And basis risk goes both ways. So, for example, there could be a scenario where, going back to hurricane, there could be a Category 3 hurricane that crosses within 40 miles of a certain specific location, and that could be seen as too far away to trigger the terms of the policy, which ultimately, could lead to some loss to the client, or the inverse scenario where there's an event that does trigger the policy, but there's ultimately no loss felt by the client. And so these are the situations that, through underwriting, through looking at back testing, risk modeling, we're able to mitigate this basis risk. And then it's important to also understand that basis risk is present in traditional insurance as well. That is, oftentimes in the form of a deductible, specific policy exclusions, sublimits, or other restrictive terms and conditions that can ultimately leave the client with, recovering less than they ultimately needed or were expecting to. And so minimizing that basis risk, I think, is the goal for all of the insurance products out there. And I think taken together, both parametric and traditional is a really nice way to further mitigate that. And then the claims process for parametric is, like I mentioned, happens very quick. This is typically finalized within 2 to 3 weeks after an event. But the way it works is typically an event will occur. The client and their broker will notify the carrier of a loss similar to traditional insurance. And then at that point, the carrier will provide what's known as an event report after they've collected the data from the third party. It's been analyzed and certified. And then you basically receive an event report, which is a summary of the event in question, the parameters of the policy, and ultimately how much that, that client is eligible to claim under their parametric policy. And then in order to essentially receive those funds, we require a declaration of loss statement, which is essentially the client attesting to, one, yes, we had a loss resulting from that event, and that loss is no less than the amount that we're recovering under this policy. And so that allows us to quickly wire funds to the client's account as soon as we receive this declaration of loss statement. And from there, the claim is settled. There's no adjustment process. There's no audit process. It's really meant to respond very quickly. The whole point is to get funds in hand immediately after an event. And that, really goes a long way as far as building resiliency, bouncing back, and continuing to operate in the face of catastrophe. So very simplified claims process. And this really allows us to kind of give clients access to the liquidity that they need without, either tapping into a credit facility or exposing their own balance sheet. And then from here, we're going to go into some actual example structures that are common in today's market. I think some of the perils that we'll talk about here are definitely relevant for all sorts of different industries, client types. It's really, I would say, those that lean towards parametric insurance come from all sorts of different industry verticals. It's really a great solution with any corporate with exposure to cat or would see some sort of business slowdown in the face of a catastrophe event. So none of these are really specifically geared to a specific asset class. But kicking off with hurricane, as I mentioned, it is a definitely, I think, one of the more popular parametric covers out there in the market today. And, an approach to parametric hurricane is, as I mentioned, identifying the asset or the location of interest to insure. And we're essentially in this scenario creating 3 concentric circles around the center coordinate. And so that's a 10-mile circle, a 20-mile circle, and a 30-mile circle. And in this example, the coverage triggers at a Cat 3 within 30 miles. And so the payout table on the right-hand side of the screen here kind of breaks down how the policy pays out. And so as you can see, the general theme is as the event intensity increases and the track comes closer to this pre-selected location, then the payout increases. And so in this scenario, you can think of the insured's deductible or retention would be any sort of loss that they experience from maybe a tropical storm, a category 1 or a category 2. And then from there, for the more severe catastrophic scenarios, Cat 3 plus is when the parametric is triggered. And that is a really nice way to kind of design the cover in a way that's meant to really respond to those severity-based scenarios. And so in this example, you have a category 5 hurricane passing through that middle location. And so that's consistent with a 40% payout of the annual aggregate limit. And so if they had a $10 million annual aggregate limit in place, this would have triggered a $4 million payout. And it would have been very clear, basically from the day after the storm, what that kind of claims payout is expected to be. And this allows everyone to kind of move much more quickly after an event to kind of get back on their feet. So what's important to note for hurricane, we're looking at both wind speed and the distance to a central or pre-agreed location. It's also important to keep in mind that all of these different metrics are interchangeable. For example, if we model the specific exposures and questions, and we find that there could be some vulnerability to Cat 2, we can adjust the payout table to respond at Cat 2. Or alternatively, if a client is really just concerned about the worst case scenarios, maybe Cat 4, Cat 5, we can again adjust the cover to really only respond to those types of events. All of these different levers that we pull will have a varying impact on the price and scope of the cover. So very flexible, and there's a lot of I would say iterations that can be made before kind of finding the sweet spot as to what makes sense for a specific client. So moving over to wildfire, this is another increasingly, I would say, popular product that we underwrite. The concept is the same. Again, we're paying out based on the occurrence of an event. In this case, it's a wildfire. And so the way we design a cover like this is we'll take the property site plan or an aerial site map and establish a buffer around the insured locations, typically with a 100-meter buffer. And this allows us to, using satellite imagery, determine when a wildfire has breached this predefined coverage zone. And if so, it essentially instantaneously triggers a 100% payout. So unlike the hurricane cover, where we're kind of tiering the payments based on the intensity of the event, for wildfire, it's binary. And so the policy triggers in full if this coverage area is breached by a declared wildfire event. And so if they had a $5 million policy limit in place, for example, this policy would have triggered the full $5 million, as you can see by the burn scar when we overlay that to the client location. So pretty straightforward, but another very kind of effective and elegant way to address wildfire exposure. And this is typically, used on the wildfire side to cover high deductibles. For example, if there's a client with a wildfire deductible of say $5 million on their traditional all risk policy, then we can design a parametric cover at a $5 million limit. And then in the event of a wildfire, that brings their deductible down to zero. So it's a great way to fully hedge against a deductible in a scenario like this. And then the way we do earthquake is typically on a PGA basis, which stands for peak ground acceleration. This is essentially a measure of how much the Earth is shaking at a specific point on the map, and this allows us to have an understanding of, a very granular understanding of how much an earthquake, how much damage an earthquake has caused at a very specific area. And the third party data that we use for earthquake structures is typically from the USGS. It's all public data, and there's a very well um, researched and explored network of earthquake sensors all throughout the Pacific Northwest and California that allows the USGS to create these shake maps. And this is essentially what is used to settle claims on a parametric basis. And similarly to hurricane, we're tiering the payouts based on the intensity of the shaking event. And this is to be consistent with the expected damage. And so a lot of times for clients in places like California, we're looking at maybe engineering reports or different studies that kind of speak to a building's structural integrity relative to earthquake shaking. And that allows us to design a structure that complements the engineering of the building in a way that really minimizes that basis risk. And so we can be confident that we're proposing a structure that's going to respond, when they need it. And so, here's a pretty straightforward example where the strike point is 40% G, which is percent gravity. That's the metric that's used to quantify PGA. And it exhausts that, 100% payout can be obtained when there's 120% G shake intensity on site, which is consistent with a very strong high magnitude earthquake event. And then another, common cover we're seeing, I think, especially as severe convective storm activity continues to create capacity constraints for carriers, is a parametric tornado cover. And so again, we're taking a very specific and pre-agreed polygon that outlines the client site, and we're able to overlay this with data from the National Weather Service, and we have an understanding of the intensity of a tornado when it impacts a certain site and the percentage of the total site that's impacted by the various intensities. So one thing, tornado tend to cause very localized damage radius. So, it's not uncommon for a tornado to rip through town and one side of the street is completely destroyed and the other looks like nothing happened. And so we're able to kind of capture that phenomenon by one, looking at the percentage of the total area that's been impacted, and then two, the level of intensity that it's been impacted. And so we can say in this example, 45% of the coverage area was impacted by EF2 intensities. And EF2 intensity is, that leads to a 50% payout of the aggregate limit. And 30% of this coverage area was impacted by EF1 intensity. So this single tornado event impacted the client's site at two different intensities. And so when we calculate the payout, all of that is taken into account. And the formula at the bottom of the screen there is kind of explaining how we got to that 27% payout of the annual aggregate limit. And so again, tornado, it's the payout is based 100% off the event intensity and the area impacted. And so this allows us to have an understanding of how they were impacted in the total payout very quickly after the event occurs. And so again, consistent with the parametric concept that we're able to provide funds near immediately after an event. And then hail is another common parametric cover, especially I think, similar to tornado, severe convective storm constraints on the traditional market have created a lot more opportunity in the parametric space. The way parametric hail works is the payout is determined by the hailstone size that's detected by radar technology. There's also covers there you can install on-site sensors. So there's a variety of different approaches to how you're actually going to quantify that hail size. But what's most common, I would say, is using radar technology. There's a catalog of data offered by NOAA that allows us to in real time see the different hail swaths or hail footprints after a storm and have an understanding of what size hail is impacting various assets. And similarly to tornado, this also will typically take into account the percent of area impacted. And so when you do have an event that causes multiple hailstone sizes across, a specific geography, you can expect to have different kind of thresholds of damage. And so using the area impacted approach allows us to kind of further dial in the coverage in a way that responds adequately and to the extent that they need it to. And so in this particular example, the triggering hail size is 2.25 inches. And then the maximum hail size, or the hail size at which would deploy 100% of the limit, is 3.5 inches. So extremely large hail we're covering. Again, parametric in general is a severity-based cover. It works best to respond to highly catastrophic scenarios. And so particularly, solar farms, I think is what we're seeing the most traction in the market with today for our hail cover. But if really any sort of corporate with exposed to catastrophic hail could find, a very good solution through a parametric approach. And then, so that's kind of a basic intro. I think at this point, we're going to flip it over to Austin Castle from Lockton to kind of give us an update on what he's been seeing in the marketplace, from a traditional standpoint, and then also to discuss a little bit about what he's saying on his day-to-day as far as parametric insurance and how those are kind of working together to create well-rounded risk transfer programs. So, Austin, floor is yours.
Good day, everybody. My name is Austin Castle. I'm an account executive over at Lockton Companies. I focus specifically on property insurance, whether that be standalone all risk property, whether that be cat peril specific with tornado, wildfire, named wind, flood, earthquake, as well as other cargo and inland marine coverages. Throughout the market, which we'll get to in a moment, we've been able to see that due to challenges, parametric insurance has become much more popular, like Will had been talking about. And I'll, after the market update, I'll share some examples of how I've used this with Descartes, with clients to help their overall insurance buying and risk transfer strategies and just situation improve, even in the face of a challenging traditional insurance marketplace. Going back to 2017, we saw catastrophic events really take center stage, specifically with named wind and wildfire. We had the Harvey, Irma, and Maria hurricanes, as well as the Camp and Paradise wildfires. With all of those events, as well as other attritional losses, sort of build up until the second quarter of 2019, when, in my opinion, the property hard market really began. And while it's been softening since, we are still in an ongoing hard market. In that second quarter of 2019, we saw rates expand greatly on both just all risk as well as cat perils. In 2020, 2021, we had the worries of COVID and how much of COVID claims would be impacting the property insurance market, as well as in 2021, 22, a major shift in total inflation's impact on total insurable values. In prior years, that had only been 2 to 3% inflation factor on building and contents values. By the time we got to 2021 and 2022, we saw guidance from FM Global up to 18% for building cost trend index, as well as 7% for contents. And throughout this time, insurance markets were managing their portfolios by either declining accounts, non-renewing them, really pulling back in specific areas such as just more challenging occupancies like pulp and paper, or through just getting out or greatly reducing their exposures to named windstorm. And through that time period from 2019 through really 2024, we saw steady rate increases anywhere from 10% to 50%. In some years, clients saw uh, 2x, 3x, 4x total rate increases. And now this year, we're starting to see 5, 10, 15% rate decreases on these programs that have been affected. But of course, that's coming off of many clients who've experienced up to 500, 600% rate increases over the past few years. Now, specifically when it comes to cat perils, I'll go cat peril by cat peril. But where the main issues have popped up have been a named storm, severe convective storm, as well as wildfire. If we start with named storm, on the heels of the um, Harvey, Irma, Maria, and other named wind events, we saw steady percent increases on the total insurable values for deductibles, specifically in Louisiana, Texas, and Florida. But that just increased to total tier one zones, which would include Alabama and certain parts of Georgia, even sometimes in parts of North Carolina, and as well as Mississippi. But also for tier two, where we might see 2% wind hail deductibles in addition to the 5% for tier one. And what took place during that time is that we saw a severe cutback in limit from 2019 through 2023, as well as the increased retentions and then the rates going through the roof. That was mostly because of one, losses to the market, two, the insurer's opinion that they didn't have significant deductible, or rather appropriate uh, deductibles on the cat perils themselves. But then three, the capacity in the marketplace just shrank dramatically. We had lots of insurers that were being ordered by Wall Street to reduce their average annual losses, otherwise known as AAL, in order to meet the street's demands and profitability. So when we had much less supply, but a greater need for additional limits, especially in the face of major events, the named storm market was just undergoing a very tumultuous time. And in 2022, the overall market looked to be shaping up like it would be plateauing. But in September of that year, Hurricane Ian struck and really just started the whole cycle all over again. And the main reason for that was because much of the named storm capacity was in the reinsurance marketplace. And when Hurricane Ian caused significant flooding, as well as named storm damage, the market, which was already slightly declining in capacity, when that took that major financial hit, then the rest of the reinsurance marketplace, whether you're exposed to named wind or not, followed suit with increasing rates, reducing capacity, and increasing retentions. In fact, in 2024, there's a common tagline called double half in the reinsurance marketplace, where reinsurers renewals for retail insurers look something like double the rate, double the retention, but half the total capacity available. So 2023 was a extremely challenging year in the property insurance marketplace, but especially for those exposed to named storm. And thankfully, in 2024, this started to change in the second quarter as enough insurers had seen a few years of profitability. They had raised their retentions in a significant way, as well as managed their portfolios to um, continue to provide insurance for customers that they wanted to have long-term relationships with, rather than just pop in and pop out of the market. But what all this created opportunity for, specifically a named storm, was the potential for alternative risk insurance. And that is where companies like Descartes come in with their named storm peril. And during that time, I placed several Descartes-led parametric programs for different clients which met a number of their concerns. The first one of that was just general capacity in the first place. So when the traditional named storm market was lacking capacity, let's say we take a client that had a $100 million named storm tower all provided by one insurer, and that insurer then non-renewed them, they needed $100 million of capacity, which now needed to be put together either through a shared and layered traditional named storm peril program, or something like a parametric. Or they might have to take less limit overall, but that was something that many insurers could not do either through risk tolerance or contract obligations. Where Descartes and just parametric insurance in general came into play was one, that they were able to provide capacity at reasonable rates. Two was that all of these insureds that had experienced non-renewals had typically had a loss that followed previously, whether it was significant or not. And what that meant is that they had gone through challenging times due to that related peril, especially on the claim front, as they might have been able to be paid out for their property damage piece in a reasonable amount of time, but oftentimes these repairs were delayed or the payment for the repairs were delayed. But one thing was for certain was that all of the time element loss was significantly delayed, as there's a major backlog in accounting, as well as just not knowing what the exact time element loss might have been. And so I had several insureds and customers and clients who incurred a loss, say in 2020, but didn't receive their full claim payout until 2023, just due to the logistics of time element and some property damage claim elements. So you had customers who were either dipping into lines of credit, customers that were maybe needing to take on just an additional formal commercial loan, or having to shut down certain buildings, departments until they could receive funds to get them started back up. So this is a way that, during these really challenging times, parametric insurance became really essential for them going forward. And the fact that it was able to operate outside of a traditional named storm program was really beneficial. So you can see some of these parametric in action screens where you have the carve out in the upper right part of the slide. One thing that most of my clients that took a parametric and traditional named storm route did was that they had a, say, $25 or $50 million named storm parametric product, and then also had a traditional named storm product anywhere between $25 and $75 million. And what they were able to do is say, okay, we will buy the parametric product. We know that we will have coverage at first dollar, that it will pay out quick, that we won't have exclusions related to our loss, but rather just any economic loss that we incur, we'll be able to be indemnified for. And then we'll use our traditional named storm tower for the really, truly catastrophic events, but have it subject to either the traditional 5% total insurable value named storm deductible, or an intentional $25, $50 million self-insured retention that will be either mostly or potentially 100% covered by the parametric product, and then have cheaper than expected traditional named storm limits sort of sit secondary to that. So while they operate they don't, like the traditional storm doesn't attach to the parametric product, you can craft it in a way to where it more or less functions as if it did. In worst case, you're oftentimes just bumping retention further up the tower rather than receiving it right away. So that's a way that it was used. The additional capacity piece in the upper left-hand corner, that if there wasn't enough capacity in the marketplace, the traditional marketplace, the alternative risk finance space through parametric insurance could be accessed to build those limits. The deductible buy down was used oftentimes just to say, if I had a 5% deductible that equated to $10 million, you could take a $10 million parametric program to cover that. And then the protection gap coverage, just knowing that there might only be part of a tower filled out. And the parametric, let's say it's 60% of a $100 million tower was filled out, you could buy a $40 million parametric product to equal the $100 million, even though they might be at differing terms and conditions. So these are just 4 different ways that our insurers, or excuse me, that our clients made up for the lack of capacity from traditional named storm carriers during the past several years. So the question might be, okay, now we're in a place in 2025 where since the second quarter of 2024, the market's been softening some. I'd remind everybody that we are still very much in a hard market. Just because we're down 10 points doesn't mean that it's all of a sudden in a really advantageous position. That now, how are parametrics being used? Well, they're continuing to be used because I think that our customers and clients really enjoy the idea of having an initial quick cash flow within a couple weeks on a certain event for it covering economic loss, which oftentimes economic loss is a much broader definition than what might come through traditional insurance products. It's the idea of knowing that you're diversified in your insurer access point, that you have the steady Descartes parametric insurance, and then have the traditional marketplace, which has been fluctuating quite a bit. Will noted that we're oftentimes seeing flat renewals. All of my clients thus far, the past few years, have received flat renewals because the Descartes parametric insurance is not necessarily based on what's going on in the rest of the market, but rather what's going on inside of the models. And so that just provides a greater consistency in a different way for products to be priced. So what's gone on is really, as traditional insurance might become more appealing through either greater terms or greater capacity or through cheaper price, what's gone on is that parametric insurance can just be tailored to that. You could have you could consider as a client reducing your parametric insurance if you needed that some years, but there may be years that you want to increase it. And knowing that you have a fairly steady rate online in general, you can estimate what that might be. Whereas traditional marketplace, you need to go through the standard quoting process. Just looking at my notes from a couple examples of where clients have, expressed their appreciation for parametric insurance. One of the ways is that there was an insurer with a client who had significantly reduced their overall traditional uh, named storm cover. Then what they had decided to do was just cover the large majority of their named storm cover with parametric insurance. And then as they got more comfortable with it, saw steady renewals, saw that there were being claims paid out, they ended up actually just forfeiting the named storm piece of their traditional insurance and went 100% with parametric insurance. One of the reasons was because they felt that they knew their risk, and for good reason, really well, and that if there was a scenario in which they suffered a loss, they believed it would be minimal, and they wanted to be paid first dollar. And they saw a 5% named storm deductible as being almost kind of pointless because they felt that they were either going to have no loss or they were going to have a loss that exceeded everything, exceeded the limits that they might have been purchasing otherwise on the traditional property policy. So they excluded that piece on the traditional all risk cover and decided to just purchase 100% parametric insurance. It's probably something that Will would say is not common, but it is something that when you know your business well and you know your risks, you can really fully invest and tailor your insurance risk transfer to the best of your abilities for your own business. So that's, on the named storm front, how we've seen things. When it comes to convective storm and how, the marketplace has been going, it's been very similar to named storm. In general, almost all insurers will still afford you full limits, the full policy limit, but they've certainly been pressing on 1%, 2%, 3%, 5% severe convective storm deductibles. It's very rare that you'll see a flat deductible across a large program any longer, especially as the convective storm, tornado, hail, and derechos really move south and eastward. We traditionally think of convective storms as just being Tornado Alley, Oklahoma, Texas, Kansas, Missouri. But the 2 largest tornadoes 2 years ago were in Tupelo, Mississippi, and Rocky Mount, North Carolina. And so insurers are picking up on this. They're seeing that models are not capturing what is the present day expansion of the convective storm zones. And so it's something that your broker might not always be aware of, seeing that you might have a percentage deductible applied to, any location is usually harmful, but especially very large locations. And having a deductible that might be 5% on a $500 million facility, at that point, you might be just self-insuring the impact of a strong windstorm or hail. And that's when you can start to think about having coverage for what is essentially a coverage gap on a property policy. If you have a 5, 10, 15 million, $15 million wind hail deductible, and you know that that's just going to mostly affect your roof, that might be the cost of your roof and then some. And so if you want cover for that, Parametric is a great alternative. And then finally on wildfire, we've seen a lot of scenarios with clients that might be in the mountains or clients that are in California, especially knowing the fires that took place earlier this year in Los Angeles and the greater metropolitan area. We've seen that wildfires can be excluded or that wildfire has a significant deductible. And Descartes and other parametric providers are able to, really tailor coverage with providing wildfire and coverage in some areas because it's a risk that is really, really challenging to predict of one, when it will occur, two, where it will occur, and three, how damaging it will it be. And so it's something that in all of this uncertainty, it might not be a bad idea to have additional line of cover to be able to protect yourself with. So, overall, the market has improved some this past year, but we're coming off of 5 really, really challenging years. Actually, it's greater than 5. It's almost 7 really, really challenging years in the property insurance marketplace. We've seen cat deductibles rise, limits shrink, prices go up dramatically. So much so that oftentimes coverage was not available for a named storm and wildfire. And we've seen increased deductibles for all 3 of those main perils. And so the way to think about property insurance pairing with parametric property insurance is as a supplement in most cases, a supplement over a consistent time period. It's not something that I think you want to bounce in and out of the market with of, hey, you had a tough renewal or you lost some coverage. It's time to come in with some parametric insurance. I view it as something that if it makes sense for your business, for it to be a long-term partnership, because it will be able to provide relief for you all when you need it most. And it will be able to be there to tailor with your programs when the traditional property market inevitably changes as it is right now. So I think it's a type of product and across all perils that should be considered for your business for not just a quick fix, but a long-term business partnership.
All right. Thank you very much, Austin, for that market update. It's very helpful to kind of know how these are being placed in the market today with some tangible real life examples. So appreciate the update there. And then to kind of summarize what we've talked about today, the key points are that parametric insurance is highly flexible and transparent. It should be very clear, what is impacting the rate, what events are covered, what events are not covered. And it's all very data driven. So the third party data set that you're using to settle the claims is extremely important. And some of the main, I think, benefits that Austin mentioned are, there is no deductible when the policy is triggered. It's paid out on a first dollar basis. There's no exclusions or sublimits that you'd be used to on a traditional policy. It's a great way to fill in those gaps in a broader property program. Key reason I think a lot of clients purchase Parametric is for the near immediate indemnification, access to liquidity after an event, very quick, instantaneous payouts that are not based on a manual loss adjustment. And so this allows us to really streamline things on the claim side, putting money in your pockets very quickly and when you need it the most. So I think that's a key reason that these are also kind of taking shape in the market, and that value add is something that's here to stay throughout, whether it's a soft or hard market cycle. And then, as Austin kind of touched on, the enhanced coverage and portfolio diversification as well, and putting all of your eggs in one basket, so to speak, whether that's the traditional insurance or property insurance markets that could, lead to more volatile premiums year over year, making it more difficult to budget and plan for next year's renewal cycle. And so, with something like Parametric in place to kind of hedge against that volatility, keeping rates stable, and giving you a kind of a heads up on what you can expect to be seeing in the renewal term is I think a very key differentiator as well for Parametric. Also important to note that the economic coverage, the broader economic coverage you get from Parametric, I think is another key point that needs to be talked about here as we summarize things. It's a great way to cover items that are either excluded or maybe something that you wouldn't expect to be able to claim under an insurance contract in the first place, such as non-damage business interruption, contingent exposures. For example, if you place a parametric coverage area over maybe it's a non-owned asset, but perhaps something in the supply chain that if that infrastructure is impacted by an event, it can have an impact on your company's bottom line. So it's a great way to kind of cover these same items on a contingent basis. That being said, I think at this point we have had some questions come in, so we'll take some time to address some of those questions.
All right, great. That was a great session. You got a lot of engagement here. I'm going to kick things off with a question that we've got, and then I'll move some things over to the chat for you so that you can see those as well. First question out of the gate is, what is needed to get started with a parametric quote?
So to kick things off with the quoting process, it's actually a lot simpler than what most would be used to on the traditional side. Again, because the underwriting focus is on the peril itself. We really just need to know, one, where the assets are located, the peril in question, the pain point, whether that's cyclone, earthquake, wildfire, etc. And then the desired limit to be covered on a parametric basis, which is oftentimes informed by risk modeling. It's informed by gaps in the traditional program or exclusions. And then also it helps to have an idea of historical losses relative to the events or types of event in question. And this is typically just help us design and calibrate the trigger thresholds accordingly. It's not like we're loss rating or penalizing clients for having claims in the past. It's just more of a way to, again, make sure that we're designing the structure in a way that back tests well against prior scenarios.
Excellent. And folks, I want to mention we got a lot of great questions. Will's going to get to as many as we can. We might stick around for an extra couple of minutes if he's up for it. Are you up for it?
Yeah, I can hang out.
Okay. Do you see the first one in the chat to you? You okay with it?
Yep.
Okay, I'll read it aloud. Have you seen any development of parametric options for athletic risks in revenue interruption from loss of key players due to injuries under name, image, and likeness agreements, or that were recipients of settlements? This may be an emerging area for this type of insurance. Wild question. What do you think?
Potentially, it's not something that I've seen in the market, a product like this, but it is interesting, and it could, if designed properly, and there's relevant data to underwrite, it could be designed in a way where it's possible. But I currently don't know of any products out there like this, and I think the challenge would really be having that kind of data set to underwrite against. I'm not sure if it exists for stuff like that, as kind of NIL is a more recent development, but
Yeah,
definitely an interesting use case.
All right. So next one. So proof of loss statement is required, and the product will only pay out to the extent that the actual loss is greater than or equal to the contractual parametric limit or amount. Is that correct?
Yes. So basically, there is a declaration of loss statement required, and this is really to make sure that we are in fact covering a loss, and there's no one able to, essentially be left better off from a claim scenario. But typically the way these policies are designed and how they're structured, again, being a severity-based coverage, and they're also supplemental. So it's unlikely that the parametric is covering the total extent of a building's values or a company's exposure. And so when triggered, it's typically one, in a scenario that's highly catastrophic, and then two, it's just kind of a portion or a layer that the parametric is being allocated to. So typically, if designed properly, the total loss amount from an event far exceeds, the parametric recovery.
All right, great. And how much does a parametric policy cost on average?
So when it comes to cost, there's a few different things to keep in mind and a few different kind of levers that can be tinkered with to get to a specific coverage need or price point. But really, I think parametric insurance more generally has a reputation for being expensive. In some cases it is, but in many cases it's also not. So it really just depends on one, where are the assets located, and is it an area where the probability of the event in question is happening quite often? It makes sense that the more frequent a claim is expected to pay or expected to happen, then the higher the price. But given the nature of parametric policies, we can design kind of the trigger thresholds in a way that really kind of isolates specific events. For example, if we have a risk in Miami, Florida, and we cover it with a 50-mile radius triggering at a category 1, that's going to be a lot more expensive than just covering severity Cat 4 or 5 events within a 25-mile radius. That's going to have a completely different impact on the rate online. And so I guess to answer the question, it's, these policies can be structured to be, cheap or as expensive as you want to make them, depending on what kind of scenario you're trying to address. But there is a lot of kind of wiggle room, I would say, and no set structure or quote should be taken as final. There's a lot of kind of iterations and tweaks that could be made to cover to fit within a specific price point.
Excellent. Stick around, folks. We got more questions being answered right now by Will. Will, have you used parametric insurance in conjunction with a captive insurance company and traditional insurance as part of a property tower?
Yes. Quite often parametric insurance is used to reinsure a captive for specific scenarios that maybe the captive is not capitalized well enough in its early stages to address. Or we can also build parametric triggers into a captive and do the monitoring of the trigger and the event calculations and event reports on behalf of the captive. But the captive is ultimately the one that is administering the claim payments. But we've supported captives in a way where we're kind of helping them build these parametric triggers into the captive. But yeah, we are frequently working with captives to help either reinsure them or input parametric triggers into the captive itself.
All right, excellent. What sorts of losses need to be shown to initiate claims payments?
So really what to initiate the claims payments, all that's needed is that declaration of loss statement. And it's essentially a signature from the client certifying that they did have a loss, and that loss ultimately exceeds what they're collecting under the parametric program. Now, the whole point of parametric insurance is to act very quickly and to put funds in clients' hands early on. And of course, it's very difficult to know an exact dollar amount of your total expected loss early on after an event. And so the declaration of loss wording is typically structured in a way that gives the client some wiggle room. And we're not asking for an exact dollar amount, just an indication that the expected total loss amount is going to be greater than the amount recovered under the policy. Once that's received, we can initiate claims payments. And really, this declaration of loss component is what keeps it an insurance product as opposed to some sort of weather derivative or financial derivative. It ensures that it's indemnifying a loss. But once we have that certification of loss statement, it's not like we audit the claims payout or audit the actual loss or collect receipts. It's really it's closed out for all intents and purposes once we receive that statement.
Good. And I think that answers this next question also, but I'm just going to throw it out there because you mentioned the declaration of loss. Somebody was asking if you could just explain it a little further. Does it mean that it is not possible for an insured to receive a payout where it has not suffered a loss to that extent? So I feel like you kind of hit on that, but if I missed something, please feel free to elaborate.
Let's see.
Right there for you.
Yeah, no, I think that kind of hits it.
Yeah.
There is a period where, if, for example, a client is entitled, the program triggers, they're entitled to $10 million in early stages. They can't confidently sign a declaration of loss saying that they're entitled or that they experienced a $10 million loss. They can, in that instance, submit, the loss amount for which they feel more confident in providing at the declaration of loss stage. And then over time, they can provide additional declaration of losses that, we will wire funds up to that initial 10 million that they were initially eligible for. And that's if in scenarios where they would have difficulty or not full confidence in being able to certify the $10 million loss up front. So there is a little bit of a room to make right as the true loss kind of develops. But again, it kind of goes back to how the policies are structured, how they're designed. And typically when your parametric triggers, a catastrophic scenario has happened, and it's usually 99% of the time no problem to be able to quickly submit that declaration of loss statement.
Excellent. We're gonna try to stick around and get one or two more. I just dropped one in the chat for you. If you're okay with it, just give me a thumb. Just say you're okay with it. I'll read it aloud.
Yeah.
Okay. This will be either the last or the penultimate question, folks. That's an SAT word. Have you seen most loss payments being high enough to pay for the replacing of the building, or do they typically only cover a partial loss?
So this really depends, again, how the policy is structured. There are instances like Austin had mentioned previously where insureds are looking at a parametric policy at a very high limit basis, and they're looking to use it as more of a carve out and as opposed to a complement or supplement to the traditional coverage. And in these cases, absolutely, there's times where a policy triggers and the payout is substantial, significant, and enough to address their full replacement cost or what has it. But more often than not, it is a supplement. We're covering a deductible or a layer higher up in an excess tower, for example, as opposed to using the parametric as kind of a one-stop insurance product for the full assets replacement cost. But it's all about how it's designed, comfortability in the trigger thresholds and how well the different payout coefficients line up with actual losses.
All right, excellent. We got one last one here, and folks, if you have more questions, just drop them in. Make sure that your name is attached so that Will and the Descartes team can reply to you directly afterwards. Last question: are paid receipts or repair estimates fine to submit, or do you need a full exactimate estimate?
So we do not require any sort of receipts or estimates. It's really, for example, I think the main reason for the declaration of loss component of the cover is to ensure that this it's covering a loss. So it's not your insurance carrier in terms of a parametric claim scenario. It's not your insurance carrier that would be interested in auditing the account, because whatever loss amount you're entitled to, it's already been rated for in the underwriting process, and it's the carriers expects to pay the 100% of whatever amount you're eligible for, and it's in the client's best interest to think of all of the ways in which they've been impacted in an event to be able to justify receiving that 100% of that payout. And so it's not the insurance carrier that would request receipts or audit in any chance. It really comes down to a kind of a regulatory standpoint. For example, if a client receives a $10 million payout on their balance sheet, it might, like the IRS or some other similar institution, maybe they may ask for proof that it is in fact covering a loss. But for the intents and purposes of the insurance carrier and the way the contract's written, it's not relevant to provide receipts or damage estimates. It's really just to be able to confidently sign that declaration of loss statement and submit the loss letter. And then from there, the claim has been adjusted. And so I know that's a very different way of thinking about claims and compared to the traditional sense, but really that's the whole point of parametric. It's meant to, one, respond very quickly and give you the flexibility to use those funds as you need, whether that's immediately, bidding on contractors to come in and make repairs after an event, cleanup costs, extra expenses, maybe relocating assets or employees, paying employees overtime. These are all sort of economic costs that can be covered under a parametric policy. And a lot of them are kind of unforeseen in a catastrophic scenario. So it's really kind of flips the claims process on its head, where we give you the money up front and you can actually use it as you see fit. So long as the total loss amount exceeds what you've recovered under the contract.
Excellent. So Will, let's have you advance your slide. And folks, quick reminder, we've got about 90 to 120 seconds left. Drop your questions in the Q&A box. Make sure that your name is attached to it so that Will and the team can reach back out to you. I'd like to thank Will, and I'd like to thank Austin Castle of Lockton Companies. Will McMillan and the Descartes team have your questions, and we'll reply to you directly if we didn't address them today. A copy of this webinar will be archived on the webinars page of rims.org down on the bottom on the on-demand page in a few business days. There are lots of resources for you all to access. Take a look at your screen. Visit DescartesUnderwriting.com and also follow Descartes on LinkedIn. And folks, like we said at the top, Risk World will be held in Chicago, Illinois, May 4th through May 7th. Public registration is open, and you can register at rims.org/riskworld. Descartes has 2 sessions, one on May 5th on parametric insurance. That's at booth 825 on the global stage, and May 6th, the evolving wildfire landscape, and in the Thought Leader Theater on booth 491. So check those out. And finally, folks, RIMS is global, and we would love for you to build your network with us. Visit rims.org/membership to apply for a RIMS membership. This was a lot of fun. I learned a lot, and I'd like to thank Will and the Descartes team. Thank you all, and stay safe.